All right, folks, welcome back. This is the daily log entry for February 25th, 2021. All right, so I mentioned there would be some concern if we traded to this rejection block here and then higher. So we did not want to see that. So I want to talk a little bit about the importance of the Thursday New York session and how you can predict potential reversals so that way you don't give up the lion's portion of the move that you've tried to capture for that particular day or that week, and how you can anticipate but not always know for certain. Okay, so there's always that little gray area. Remember, I'm in the 90%, not the 100% strike rate. So you're going to learn a little bit about algorithmic theory in this lesson. I'm going to try not to be too long-winded, but I'll try to keep it as short and concise as possible. But go back and listen to the recording yesterday. So that down close price right there, that's the one that is important because that's your rejection block. This run down takes the stops below that and rallies higher. So much in the same way like a breaker would be like this low, the high, and the lower low, and once it trades back down into it, we find support. This formation and price, the algorithm remembers this. So it's the lowest down closing price in a swing that was broken on the downside, then rejects away. So your rejection block is that particular price level right there. So we're extending it through all these candles into time. If the algorithm goes to this price level, trades through, and then comes right back up, it's signaling that there could be potentially a reversal. Now, this is further evidenced if it is also on a Thursday. And if that occurs, we have that same opposite end of the range phenomenon that takes place in the New York session on Thursday. So there's a lot of rules that the algorithm likes to follow, and these rules have parameters and conditions that must be met. And that's what makes algorithmic trading a little bit intimidating, I guess, for someone that's new, because there's a lot of things that you're not supposed to do and what you're supposed to do at specific times. And humans by nature are not really good rule followers. When we have this condition met, as I outlined, then it's concerning. And we'll talk about that as we get into the time of day and day of week study portion of this video. Now, looking at the dollar index, now you all are usually just seeing the euro and cable, but I'm bringing in this discussion and teaching because it's salient. It's something that I outlined yesterday, gave you reasons for concern around that particular level. And what I have is that same rejection block that's on the daily candle of December 17th, 2020. Right? So 2020, December 17th, that level's carried out into the future. And now this is Thursday's trading. So midnight New York, and then 2 o'clock in the afternoon New York time. Notice that the market trades down into and through that rejection block ahead of the 7 o'clock New York open kill zone. Now, this time window here, this is what you put in for your notes. 7 o'clock in the morning to noon. 7 o'clock in the morning to noon Eastern Standard Time. So whatever time it is in New York, you want to make sure that you're anticipating this range on Thursdays because it could potentially cap the weekly range. It does not happen every single week this way. And I'm also stating here that nothing says that this can't ultimately go lower overnight on some kind of a price run and take out this low and go lower. I'm just giving you the framework on how not to ride out all of this because this could potentially be an intermediate term reversal. So we have to see what we get on Friday and then on Sunday's trading. So if you're in a move, say you were short back here dollar or in here in long foreign currency, wouldn't you want to know when these turning points are likely to form so that way you're not caught off guard? That's what I'm teaching here tonight. Now, this isn't the first time I mentioned how Thursday's New York session caps the weekly range. We've been talking about this for a number of weeks now. I'm trying to frame the idea of how the market delivers the daily ranges, how the intraday turning points occur at the kill zones as I teach them, and how that framework works within the higher time frame bias that I give you in the commentaries. This video kind of divides that portion, and for the next couple weeks, majority of March and maybe half of April, each video is going to be predominantly teachings. Okay, it's going to be lessons. Now, I'm not going to be pointing to anything like, here's where the market's going to go here, focus there. I don't want you thinking anything like that for the next couple weeks. Okay, now when I say couple, I'm not talking about 2. Like I said, it could be as many as 6 weeks before we go back into pointing where the market's going to go to next. Now, I already know some of you are hissing and moaning. Oh, come on, ICT. I need the time in the videos to teach the lessons because I've not really considered too much until just recently. The number of videos that you're getting now, it's overwhelming. Remember, you're only supposed to be getting a Wednesday video and a weekend video. And for charter members, they'll have another video. And I'll have it to you before we close on February. Last day of every month going forward, that's when the next charter member video will go. Okay, so there hasn't been technically a charter member video for 2021 yet. So the last day of February, the 28th, that is the day you'll get your charter video. All right, so the amount of content you're getting is a lot. So the question I'm getting is, where am I supposed to go? Because this is crazy. Like, I already have a ton of videos to look at. What's the order I'm supposed to go in? And I'm going to say it again here so that way you know how to use your time going forward. The lessons that I'm giving you every single day, you need to be considering them as the most important. So right now, the real-time stuff that comes to you, that's the most important. You're going to hear things that you're not going to understand or have any understanding about the importance of it. So you're going to be recording those questions and concerns in your journal. The next videos that are the highest in importance is the 8 videos that come in each month's content. So you're going to study that, because by going through those, it helps you understand from a foundational standpoint the things I'm talking about in these lessons. Do not feel lost. I got a couple emails from new members and they're saying, like, this is way too much. Like, I feel like I'm completely oblivious to what's going on and it's whizzing by me at 100 miles an hour. I'm getting scared and concerned that I'm not going to get this. It's only because you're brand new, and I'm opening the floodgates here because this is my last teaching technically for the mentorship, and it'll just be community and companionship, in casual, Discord in our forum after this. It doesn't mean if you have a question I won't cover it or make a video to discuss it. It just means that I have to dial back how much content I'm giving you. Once you go through the 8 lessons at your leisure, okay, digest all the old commentaries for each individual month and do them in the order they were given to you. Don't skip around. Go through them in the order they were given. That's the order to go through the mentorship. Okay. But the main thing is focus on what I'm showing you each day, except for Saturday because there's no videos on Saturdays. That is going to help you get up to speed quicker, even though it's going to give you initial confusion many times, because I'm going to talk about something and it's going to feel like, what is he talking about when it comes to propulsion block? All those things. There's lessons coming for all of that, but you have to go through it in small pieces. And even in small pieces, you can see it's a lot. It's like drinking from a fire hose. It'll rip your face off if you're not careful. But I promise you, if you submit to it, you are going to come out of the other end of this year like completely transformed. You're going to have so much information, practical education that you've seen applied, and you'll understand more than just simply having, oh, I watched that video. You're going to see it. You're going to have more dynamic interactions because I'm going to start bringing in homework. Okay, so I have to make these videos shorter, and this one doesn't sound like it's going to be a short one, does it? But I promise it's not going to be that long. But you're going to have interactive homework. Okay, so I'm going to provide you things that you need to go into your chart, look for specific things, mark up certain things, weigh out certain things. Is this chart meeting the criteria I'm teaching around that specific week or that time that we're covering a topic? Because it's going to give you, again, an opportunity to test yourself. And again, it's not about if I don't get what I thought I was going to get, or my answers don't match ICT's, I'm failing. No, don't think that at all. Each time you highlight an opportunity where you're weak or your understanding's lacking, that is exactly what you want to be doing while you're in mentorship, which is why I say not to trade with live funds, because it can be very convincing to watch something that I teach you and you think, oh yeah, I know that. And then go into the markets thinking you see it, and then you get burned. And it's very, very demoralizing. It's hard for me to fix that negative feeling in students. That's why I tell you, follow the rules and don't trade with live funds. You are not missing anything, folks. I promise these moves happen every single year. Every single year, these moves, these are occurring every single week, month, day. They're there. But you have to get to the skill set of knowing what you're looking for, and then you'll be able to go in there like clockwork and just pull them out. You know what's going to happen. Okay, and the lessons in month 2, I'm going to really sit you down and start breaking down how to find the days that you really want to be focusing on. I have not taught that anywhere in the mentorship yet. So again, I'm compressing a lot of bandwidth, okay, in a small little space of time. But it's going to feel like, wow, this is too much. Just endure it, okay? There's going to be plenty of opportunity to ask me questions later on, but digest it as I give it to you, okay? I promise you it's for your enrichment, and you will have exactly what you came here for. But at that 7 o'clock and noon time window, back to dollar, this is where we can get that weekly capping, or in this case, it's been weaker on the dollar, so it could create the weekly low in here. So there's a window of opportunity that the algorithm operates in. Now, generally, it's 7 o'clock to 10 o'clock in the morning. But all of this here until the close of London, this is the New York session. We will be reducing our focus from the 2 o'clock in the afternoon window to noon for the next couple weeks. So when we start next week, the daily log entries, you're going to notice a difference with this line here. It's only going to be focusing on noon, and I'll explain why that's important at that time. But it's a month 2 teaching, so anyone that hasn't paid, they won't have access to that. Okay, which also, let me put this in here real quick, and I promise I'll continue with the teaching. On the 27th of February, month 2 content forum area is going to open up to the month 1 members that are right now active. If you have not paid and your payment has not been processed yet on the 27th, even though you see the links on the forum, your username and password will not be active for that area. So if you haven't paid, you'll see it in link, but you will not have access to it because you didn't pay for it. If you don't pay by March 9th, you will obviously be removed from the forum. That doesn't mean you're removed from the mentorship entirely. It just means you have to have your payment paid by April 1st to restore your account. But if you make your payment after the 9th of March, you have to wait until the 27th of March before we do payments again. So rewind the video again. I explain it very clearly. Just know that you have to pay before March 9th to have access to the links with your username and your password for month 2. Don't think that they pop up and, oh yeah, I can get access to that now. No, you're just going to see it, but your links won't be active for you unless you paid for month 2. Okay. Anyway, so we have this rejection block here in this swing here. Now think about what I showed you on the daily chart that made this line up here. So this is that rejection block, the closing price on the candle on December 17th, 2020. Well, that same thing is occurring here. Think of this down close candle here as the same as that December 17th, 2020 candle on the daily chart. But we're looking at a 5-minute candle here. So the same phenomenon where the market dips below a specific price level and rejects, that's what this pattern is. So now we're below that daily December 17th, 2020 closing price. And this is what I said, where you don't want to see this, where it trades below it. And then watch what happens. It creates the low ahead of New York 7 a.m., rallies back above it, and then dumps one more time below that low, and specifically that closing price. Then it does what? It runs. It rejects that. So if we see this, in other words, if it goes below this low here and then snaps back above during this time window, this right here signals the importance of knowing what to look for when you can trail the stop losses real tight or take another portion off aggressively and have just a very small portion remaining on the trade just to see if it continues, or altogether just bail on the trade. Now, we don't trade dollar, but this would be an indication to collapse all, if not majority, of the longs you would have in cable or euro dollar. Okay, that's basically what I'm getting at. So the market does eventually trade back above, find support at that old rejection block, and then rallies aggressively. If you have this in mind each week, or go back through your data, okay, this is what you should be doing if you have time. Now, most of you probably don't have this much time, but if you have extra time and you're caught up in your studies, some of you are freaks and you go through information at a ridiculous pace, and you're going to be regretting that later on because you're trying to do too much, and there's no way you're recalling all this. Even if you're writing down notes, you're not retaining it. You're not thinking about it, meditating on the things that you're being taught. Like today, what's the significance of that 7 a.m. to noon? Why is that important? That's going to be discussed in month 2. But this right now is what I'm introducing to you for you to go into your charts and study that for a Thursday day of the week study. Just like when you can go through the charts and study the Tuesday day of the week study for the London Open. I want you to study all the Thursdays that you have time on Eurodollar and cable, which also, let me answer this too, because I get a lot of questions about this as well. Should you be doing other homework and daily log entries on other currencies? No. Just Eurodollar and pound dollar and the dollar index. Okay. Focus there. Don't look at the other pairs. You're here to learn. I'm teaching you how to read price action with this triad. Triad is the dollar and 2 closely correlated pairs, Euro dollar and pound dollar. I know some of you came in here with your pet pairs and it may be a yen cross or something like that, gold or oil or whatever. Simply trust me, okay? Because everything I'm teaching you with these pairs, if that's your favorite thing to have, like a gold, an oil, and maybe it's pound yen or euro yen, say that's your 3 markets that you like to work with. Well, you've really created a reason to have a lot more study than it's necessary. And you have to follow along with what I'm teaching too. And think about how much annotation time you're using to make these charts to see how they relate to what I'm showing you. It takes time, doesn't it? That's also time away from you studying new lessons and then note taking and then considering where you might find those answers by going through the search tab on the forum, because you can find a lot of answers in the commentaries. So if you start adding other markets on top of this, it's going to create such a burden. All it takes is a small little setback in your learning because you've done something you shouldn't have done, like trade with live funds while you're trying to learn how to trade. I don't care if you're profitable. You cannot trade with just pieces of what I'm giving you. And that's the trap. I'm not setting that trap for you, but that's the trap with students that are profitable or semi-profitable, break-even type trader. They come in here and they get this itch. They got, oh yeah, I'm going to go do what this video just said. And then it creates a problem. So to keep that from happening and keeping your emotions apart from the learning experience and taking your money focus away, because if you remove the emotion and the money, you're going to learn exactly how to reprice. And then you know what the default of that is. If you apply good sound money management to being able to read the tape and market, the default is going to be you're profitable if you submit. Okay, but if you don't submit, you're going to have a whole lot of trouble here. Okay, and I don't want to see you quit, and I don't want you to get frustrated. But if you follow what I'm saying, you're going to avoid those things. All right, so let's go over to the next pair. and that is the euro dollar. And this is the 5-minute chart. So if you have your chart look like this and then study it and come up with your own annotations, I'm going to show mine. All right, so I gave you the daily fair value gap. I said this is where it's going to trade up into. This is what I think it's going to reach for. So we had a framework on the daily chart. So I'm going to dig into that all through the month of March. And you're probably thinking, well, it's not that much of a move, Michael. How could it be spread across the entire month of March? We're going to get real detailed. We're going to get real detailed, and that way you'll see how to go into your charts in between my videos. So that way you're really pulling out the gems of understanding how IPTA operates and how it delivers price. But I have to ask you, obviously I can't see you respond or hear you, and please don't email me, okay, because I'm getting way too many emails. But isn't it fascinating to see how the things I'm giving you and showing you and the logic as to why it should go to these levels, and then when I point, it goes there. It's like walking a dog on a leash. Now, I don't want to sound arrogant, because that's not the point of what I'm trying to press upon you. It's the forecasting, the prognostication value of what you're learning. It's phenomenal. It gives you context to all the chaos that you see in these candles. And these folks that go out there and say, you can't time the market. You can't predict the market. Nobody knows what intraday charts are going to do. It's all noise. You have seen for the last 4 weeks plus. You have witnessed it. Now, if you are honest with yourself, the things I talked about to frame these things, you've heard me talk about them before. Maybe in casual reference, either in a YouTube video or in a commentary that you've watched, but you see me using them. Framing the idea, saying it should do this, it should not do this. If it doesn't do this, but does this, this kills the idea. That means I'm wrong. Not, well, let me go the other direction. See, there's a difference there. And you have to be able to get to that point in your analysis where you can say, this is what I want to see in price. If it delivers, I'm going to engage with that idea in mind. But if it doesn't deliver that, and something else occurs, I have to submit and say I'm wrong. And it does not mean my model's broken. It doesn't mean that I'm not intelligent. It doesn't mean anything from a negative stance. It just means that that transaction didn't align with your model. Period. Let it go. There'll be other ones. Okay. So this is the discount level of the fair value gap on the daily, and this is the premium level of the fair value gap on the daily chart of euro dollar. And this whole chart is a 5-minute chart. So we're going to add the annotations now. So here's midnight in New York. We had a breaker here. So we have a low, a high, and a lower low. You see that? Extend that out in time. Hits it beautifully in London. Also, optimal trade entry. Okay, right in here to here. See that? London, open. What's the bias? We were looking for lower prices in dollar. So a mirror image of that in euro would be higher prices in euro dollar. If it's going higher, what time of day should the low form? London open kill zone. It creates a drop down. This is a Judas swing. This is what tricks traders. They see this move, they chase it. Price rallies, comes back in, institutional order flow, right in the heart of London. You see that? Why didn't it come all the way down here, Michael? Because we've already had a stop run down here. You see that? And this was just a simple retracement back to the breaker. So the market structure is poised to have a real aggressive run. What's it going to reach for? The levels here I mentioned on the daily chart. That's our objective. That's terminus. Okay, this is where we think it's trying to reach for. It can go higher than that, but we don't care. We're focusing on this area here as a draw on liquidity. So if we're trying to buy euro, we need to see weakness in dollar, which we saw. We need to see market structure support the idea that it's potentially making a low in London, and we buy it as it trades down candles. Price rallies strong, and small little consolidation here, drops back down, fair value gap right here. Why not this one here, Michael? Because we had relative equal highs here, and it ran through. Think about the logic, what I'm about to say here, okay? Look at the difference between the time that price gets up here and makes relative equal highs versus these highs here, relative equal highs, inside of a run that just creates the potential low of the day in London. Then it runs through it. Is it likely to go up above these relative equal highs and go lower? No, the framework isn't there for that. We're looking for that lower run on dollar on its daily chart, at least through that rejection block that we outlined. So if it's doing a run from here just above here, that would indicate that we're bearish on euro dollar. That's not the mindset you should have here. When you see it trade through these relative equal highs, see, this is what gets, well, at least I see it a lot. People that look for relative equal highs, they see this and they say, okay, it's going to be a sell. It's going to short because the market runs through these here and it rejects. No, this is a speed bump sometimes. Here, it doesn't even respect it. Why? Because you're in the right direction or on side with the algorithm. So the market's pricing aggressively to get up into this area here, this fair value gap that's defined by that daily chart. So the logic needs to be, yes, we anticipate seeing it run through here, but we don't want to see it come back even for a retrace to find old resistance, broken turn support. That stuff doesn't work in these environments. So buying it on the first return back into a fair value gap while you're still in the London open kill zone, this is institutional order flow entry drill. And you can be a buyer there and not be fearful that you're chasing. And this is also where those classic continuation patterns of a bull flag work. That's how you use the logic. And like, once you get through all of my content, you're a charter member and you find continuity and consistency in reading price, go back into a classic study of continuation patterns in like a book like John Murphy's Technical Analysis of the Financial Markets, which is the retail Bible for the average trader. You're going to learn lessons how I take that stuff and use it against them, but you will know when those patterns work, which is such a fun study because you can look at a chart right now without knowing the things I'm going to teach you. And if you understand classic charting patterns like triangles and coils, pennants, flags, and head and shoulders types of things, that can fool you. You know, geometry is not the answer in trading. It's much more deeper than that. And it's all about liquidity. And I don't want you thinking that whenever you see these relative equal highs and it's going up there, that that's a sell in and of itself. It's not. This could have easily went up here, paused without coming back down, created this scenario here, just in a smaller little fractal. Like everything that took place here where it consolidated for each 5-minute candle here, it could have created one right in here, very small, came back down in here and then rallied and again denied them any retrace back to this old high. So we want to see this opening here. Why? Why is that important? Because this is a breakaway gap. We are not trading the breakout. We're trying to buy it when it goes down here. We want to see openings in price like this remain intact. Which brings the question, whenever you see a fair value gap, like this right here is an imbalance, I would label this as a buy side imbalance, sell side inefficiency. Whereas if I was looking at a area like this little area here, okay, before it becomes a balanced price range, you're probably looking at this BPR. Man, what does BPR stand for? It's balanced price range, and you'll learn about that, but I'm going to touch a little bit here. But the small little gap here, or the imbalance, by nature, and category, it is a buy side imbalance, sell side inefficiency here and here. Okay, and that's the classification for it. But how do you define it? Why am I going back and forth from fair value gap to buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency, BISI, SIBI? If I'm looking at the time frame like I am here, okay, and I can see areas where there's a buy side imbalance, sell side inefficiency, that means it's basically a big candle up, and you can frame it with a candle before and after. So it's just a small little area here. This would be labeled buy side imbalance, sell side inefficiency. If I was questioned, like, what would you call that? That's what that would be, a BISI. This is a fair value gap. Now, why did I say that and not call this a fair value gap? Because this is smaller in relationship to the range that's created here. So the larger the inefficiency is on the time frame under study, classifies it whether it be a buy side imbalance, sell side inefficiency, or a fair value gap. But they're both imbalances. It just means this is a smaller one, and this one here has a lot of responsiveness versus the larger ones. The larger ones tend to be partially traded into or half filled, and if it completely closes, that's indicative of something else that you'll learn later on in the content. Okay, but right now just know that it's important to note all those levels, extending them in time. Over time, if you do this, you're going to have a ton of these ranges extended forward. For now, keep a study going forward for a week, okay? And if you use the way I've been teaching you to manage your annotations, I know that a lot of you have been sending me other things to do as an alternative. I really like what I'm doing. I like the idea of grouping them with the object tree and then being able to ring them in whenever I want collectively. You may not like that, but whatever suits you is fine. But I'm going to stick with what I've already done. So I appreciate your tips in regards to managing all that in terms of managing the notations and annotations on the chart. But you'll see there's a way you can do it with the last 3 days and the last week and the last month. And I'll touch on that more as we go forward. But right now, do your best to manage the annotations, because you can turn them off. You can toggle them on and off. And if there's too many of them on, you focus on an hourly, focus on a 15, and focus on a 5 minute, and extend them in time. And you'll see most of them are already going to overlap anyway. So like a 1 hour imbalance may have a smaller fair value gap on a lower time frame that's more salient to where the market's trying to draw to, and it may not need to completely close in the full imbalance that would be otherwise seen on an hourly chart. It'll make sense as I touch on that, okay? But right now, we're already going on so many different topics, again, which is why I say it takes layered lessons. All of this stuff has to be given a little bit over here, a little bit over there, and then over time, you see how they dovetail together. But let me get back to this lesson here. So the institutional order flow run here, runs up, creates a small little fair value gap with a bullish order block to the left. So by itself, that right there could have been a setup that could have seen a retracement back down in at the beginning of New York Open. This right here is what I was looking at as a potential if we did not get to the fair value gap. Like for instance, say we fell short and then we consolidated and dropped down here. We didn't go as high as we did here. Say we didn't see this movement so far up in price. This means it would have been crouching below a premium PD array, which is that daily fair value gap. That's these two levels here. Again, remember what I showed you on the daily chart on Euro. Go back and look at your notes. On your daily chart, you should have that fair value gap. It'll be in the weekend commentary video. Okay, so that way I'll bring all this back into discussion. But if it would have failed to get to this level initially and drop back down in New York, I would have been inclined to take a long if it traded down into that at New York and then running up into the fair value gap. But because it traded up from here all the way up into the fair value gap, this becomes far less likely to be a factor for New York or even a trade for the day for a long. Because what we have done is we traded to the discount level of that fair value gap on the daily chart, and then we went to consequent encroachment Then we consolidated. Then we dropped down at the tail end of New York Open, trades back down into this fair value gap and this small little down close candle. I know it doesn't look like much, but it's there. So we have a fair value gap here. Add the spread to the order block, factor in some pips for the fair value gap. Buying that, then you can attack the buy side liquidity pool relative equal highs here. And it doesn't even completely close in the fair value gap. You notice that? But it does run the buy side liquidity pool. And it hits it at the beginning of the London close, 10 o'clock, which is the heart of New York session, 7 a.m. to noon. So we are at that time and day where this could potentially create the high of the week. Watch what happens. The market aggressively breaks down. So right there, you know that there is something going on. And if you're watching the dollar index, as I was showing you with my little scalping opportunity where I showed you how I monitor the dollar index on the left-hand side of my chart, and I watch the market under study and trading on the right-hand side. You can see the difference in how the dollar index was showing a willingness to resist going lower. And we're seeing that also here in reverse with it not wanting to go higher, and it really strongly breaks down. At a time, on a day, Thursday, where it potentially caps the week. In other words, this could potentially be the weekly high. Now think about that. There's going to be times when this forms and it does break down, but eventually Friday sends it higher. That's okay. But you're going to learn by going through your charts that this many times creates the high of the week, and that's it. Doesn't go any higher. Friday just fails to go any higher than that. What does that give you? What's the importance or benefit of knowing something like this? Well, it gives you the framework and logic as to why you should be taking your profits aggressively here, trailing your stop loss, taking majority of the trade off, and then leave a small portion on, because if you're wrong, it does go higher, then at least you got that. But at least you've taken off, or at least you took the majority of your trade off, and you don't get caught up in this big retracement lower. Now, it makes a lower low in the day. Notice that? Makes a lower low in the day than what we formed here in London. Does this undermine what I taught about making the low of the day in London? No, because it makes the low of the day in London, and then it runs to our target. This is terminus. So at a later time, if it breaks down and goes lower than this, then it's of no concern to us. We're not trying to keep score and saying, ha ha ha, ICT was wrong. See that? It made the low of the day here. No, think about what's going on. The context is important, folks. The low forms, if you're bullish, to buy in the London open kill zone. The terminus, the target, where the draw of liquidity is, where's it reaching for? Where's your objective? What's your levels that you're holding for if you're long? Okay, how many times can I give you ways of saying it? The idea is we're trying to see it go up into here. Okay, and it did. If it breaks down once it trades there, who cares? You should have paid yourself along the way, and you should have really paid yourself when it ran above these relative equal highs, because that's offset distribution. They put these in here, and then once they pump it up above it, they're dumping it. They're selling it and distributing it there to buyers that want to buy, trying to capture a short because they see resistance here. London closed, 10 o'clock. Bam, hits it, and you have Thursday, day of the week. High of the week potentially forming. And then, boop, there it is. So, what is this BPR? I know I've been probably driving you crazy. Can you just tell me what those three letters are talking about, ICT? All right, so we have the fair value gap here. You all know what this is. Okay, but watch what happens over here. One candle, single pass through. So we have a single pass with this range here that creates the fair value gap, extended out in time. And one candle singly passes through. Singly. Is that even a word? Note to self. Check and see. If it ain't, I just coined it. Okay. I got dibs on it. So we break through with one single pass through. Now what has happened here is the market trades on the upside, and then it trades on the downside between this level and this level. What level specifically? This candle's high, this candle's low, which makes the fair value gap. But when you have one candle pass on the upside and one pass on the downside between those respective levels, That is considered a balanced price range. We don't look at it as an inefficiency anymore because the market has done what? Offered both sides, up and down. Now watch what happens. The market trades right back up to that level. Look at the bodies, like a brick wall. Hammered, then sells off, attacks the liquidity over here. Because now anyone that's been long here, they're getting real happy, and all of a sudden reality hits them and they are not allowed to hold on to that anymore. It completely breaks down because of all the things I've discussed here. And I've already taught you in lectures before we got to this point. So there's a way to take what I'm saying and say, oh, it's hindsight. Oh, he doesn't trade in front of us. He doesn't give me the signals or setups. You know, he's fake. He's a fraud. He's this, he's that. Go back and listen. And I outlined all these things for you. The logic is there. Where the market's going is there. I'm not sitting down with you and putting you in the trades here. It's already abused as it is. I'm not going to do that much too. So back to the balanced price range. If we run up into this, to the top end, okay, the premium level of this fair value gap over here, okay, it can touch that and still get this response too. But many times you're going to see it do this. Now, if you wanted to trade short, okay, say this is the pattern that you want to focus in on. Some of you are thinking, there's no way I would trade this. I don't even understand what I'm looking at. Over time, you will, and you're going to see this a lot. If it trades up into this level here, you can say, okay, I'm going to sell short here, and I'm going to put a stop loss above this high, but not by a pip or two. You go like a 10 pip above that. So you would use 10 pips above the premium level of the fair value gap that makes up the balanced price range. Now, some of you are thinking, man, this sounds like you're making this stuff up as you go along. But the charter members are smiling right now. They're saying, man, this stuff still keeps forming. Like, it's exactly what he taught. It's in your charts all the time. And if you have extra time on a Saturday and you're just relaxing in between your regular studies, you can go through and look for areas like this. And when you find them, it does these things like this. And it's amazing. It's just the market remembers this imbalance, but it's no longer an imbalance here because it's been offered sell side now. So go back to that imbalance there, and it's hitting that. Where on earth is the level that would be considered supply, demand, support, resistance, Elliott, harmonic? Come on now. Nothing else shows that. There's nothing here that would constitute that as a specific price level that sends it lower. That's a balanced price range. That is also one of those things when I was looking at it, I was like, there's an algorithm that's remembering this imbalance, but it's been now balanced. And now it doesn't need to go any higher. It doesn't need to go higher than this to go back in that range because it's done its work on one single candle over here and another candle here. That's the key. If it's done with one pass up, one pass down, that's a balanced price range. Then you have the sell-off. Okay. Let's go over to cable. I already talked too much about this one. British pound. And here's your 5-minute chart. Frame yours like this before you compare and contrast. I don't have a whole lot on this one, just so you know. All right, so I gave you the imbalance on that daily chart in, I think it was Wednesday's video, where I showed you this level, the consequent encroachment, and in the low end of it. So the discount low, premium high, consequent encroachment, and then up above, somewhere over here, was the other levels that we were looking for as a potential upside objective. Now, some of you are probably thinking, oh, you really got this one wrong, ICT, because you said it probably isn't going to go down. No, I said I would not want to sell short this one. But ring in that 7 o'clock to noon time of day on Thursday. We have relative equal highs. Look how the market's finding support at consequent encroachment, whereas liquidity above here. So if it's going to go higher or if it goes higher to go lower, you need to be focusing here. The market trades above that, then breaks down. Notice it's rejecting after it runs the stop. Before I put any more annotations on, I want you to think and see how this liquidity is attacked right there between 7 o'clock and noon on Thursday. So this could potentially be a reversal. We don't know because we don't want to try to pick a top in a strong bull market. It's just a critical thing for you to know, because this could have screamed like it did the other day, 200 pips more. Like, you don't know what it's going to do when it's acting like this. It's being uncharacteristic. Okay, so you have to identify those moments and don't arm wrestle that stuff. That's like trying to arm wrestle a rate decision and trading ahead of the rate decision. Like, you're gambling, just like non-farm payroll. You don't know what they're going to do. It doesn't matter what the data says. If the data says it should be bullish and they scream it the other direction, they're always going to have an excuse as to why. Oh, it was priced in. Well, you didn't mention that before. So anyway, don't get caught up this move here saying, oh, see, I missed this move because I was listening to you. No, because this could have not happened, and it could have had the opposite effect. And it could have ran, as much as you see it drop down here, it could have went that much higher. And if you're trying to sell short and you were arm wrestling it and not using stops or whatever, because some of you in here do that still, it could hurt you. And that's my first priority, is to teach you where you're going to screw it up. Because that, if you can reduce that, you have a better chance of being profitable. And being profitable is going to come in and out. How you hold on to profitability and not blow it out is by knowing the things I'm teaching you. How to avoid getting caught. Here is the 5-minute annotations on top of that daily levels. London open kill zone. Creates a low here, runs up, shallow little run above this high here, consolidates and drops down ahead of New York open, and then consolidates on the consequent encroachment, and then a run up just to take out the buy side liquidity here. Now contrast and compare what that dollar index was doing at that moment. Right here, right at that moment, it was indicating to you that it was not wanting to go lower. Isn't that what I said? That you don't want to see it go down below that daily rejection block on the dollar index and then fail. You don't want to see it reject. You don't want to see it go down below it and come back above it. Well, it was indicating it right there. When buy side liquidity is taken in between the window of opportunity that caps the weekly range at a time on the day of the week of Thursday. So in the basic framework, and this is not how every week does, but if you think of like Tuesday in a bullish environment, think of Tuesday low of the week London, Thursday New York session, high of the week. You're going to see a lot of that, but there's times when the market is in a hurry and it'll create the low of the week on Monday, London. Or if London creates a low on Monday, while it's underlyingly bullish, everything around this is bullish. Monday creates a low, and then Tuesday goes lower than that on London. That many times is the low of the week. And then you can see it blast off and go higher. And then look for Thursday, like we're framing here. That's usually the high of the week forming there. If there's opportunities that have high impact or medium impact news on Friday, we could see a continuation into Friday's trading. But if there's a lack of any real significant drivers on the economic calendar, usually the framework on Thursday holds true, and you'll see the opposite end of the range. Now, what I just gave you can be reversed when you're bearish. And what I just gave you is the blueprint to making millions and millions of pips. Okay, it is literally like, that's the blueprint. Like, that's the blueprint to IPTA from a very big macro stance. Just looking at it and saying, okay, what is it doing? And that's predominantly what it's doing. Now, when it's not in a trending model, that means if it's not directionally driven, where you can see it's going to go one direction higher or one direction lower and work towards a terminus like we outlined on the Eurodollar, where we had that fair value gap on the daily chart. We knew what it was reaching for. We understood that that's where it's going to go to. So that's directionally driven. Cable has just been like steamrolling higher. So it's been real easy to call it higher, but just being careful with it, not wanting to go short. This here is one of those reversal patterns that you can see it possibly forming, but I would never have taken that trade. In all honesty, I never would have taken that trade. Even if it hasn't been doing what it's been doing, where I've been real reluctant to touch it, like say it's been just trading normally, I still would not have taken that trade. I would have taken something down in here. I would have not taken that. Okay, so if you're looking at that thinking, how could you, I wouldn't have done it. Even this optimal trade entry here, I would have looked for this to deliver. And if it did, then I'd focus down over here. What am I looking at? The breaker, the high, the low, the high that takes out that short-term high here. So the liquidity's taken there. My eye goes to this down close candle right there, extending out in time. We go lower, come back in. That's a breaker for me. It's just trading right at that. And then I would expect an expansion on the downside. Now, that sounds like hindsight. And if you have not been with me for the last couple of weeks or been with me for a number of years, that would be unacceptable for me to talk like that and let you believe any parts of it. But I think I've proven myself that I can call things, I can see it before it happens, and I can teach you how I'm doing it. So I want you to respect the fact that I'm telling you I would not have taken that trade, but what I would wait for is what I'm showing you here. And that would be a trade I would feel comfortable with. The idea would be getting short in here, so where is your stop? Where is it going to be at? The stop would have to be above the order block in here because it could use this range here to that low and retrade back up into it. But my stop would have to be above that bullish candle, which is a bearish order block. And that would be the framework. That might not be a trade that fits your model. It might be too many pips. It's all a matter of what you're willing to accept for your model and what you feel comfortable doing. But I find it interesting. It comes out of that fair value gap aggressively. We have a small little institutional order flow entry drill here, which is not annotated. And then it runs aggressively lower and right into that 140 big figure. Isn't that interesting? Hits that, bam, and consolidates. So the main takeaway in this discussion, which was really long-winded, I apologize. I didn't want it to be this long, but I had so many opportunities to talk about other things that are very closely related to, which helps you understand the logic of one or two things that's being discussed. And that's what I mean. Like the content is dense. It's a lot of things. It's a lot of moving parts. But when you take all these parts and you bring them together slowly, okay, one thread at a time, you don't see the image that I'm forming. You have no idea where I'm taking you. You have no understanding of what this is going to come together and you'll be able to see. But it really feels like, if you've never seen the movie The Matrix, it's corny to say it, but the way the guys are looking at that screen and you just see zeros and ones, everything's in binary. And the guy says to Neo, he says, "Look, I don't even see him anymore. I just see that's a blonde, that's a brunette." Well, you'll see these candles and they'll be just like that. It'll be completely something that nobody else would understand, and it would be so hard for you to describe. And you're going to appreciate how hard this is for me to articulate. It's not a matter of just do me a 5-minute video, ICT. No, there's so many things to this. It's a very, very rich tapestry that needs to be understood one thread at a time. And once I show you them over time, and then I draw the threads tighter, the image will become clear. You'll know what you're looking at. But there has to be some kind of initial confusion that you are agreeing that is normal. That's a normal thing. Over time, things will be drawn together, and then you'll start seeing, oh yeah, this is one of those moments where it makes sense for this to happen in the marketplace. And when it happens, and I've had a lot of emails this week, a lot of emails from students that just said, you know what, something just clicked and I'm seeing it now for the first time. And these are people that have been with me for a while, not just the members that just started last year or whatever. I'm talking 2017, 2018 group. They're like, this, it just finally happened. Like, I see it. I had my epiphany. I had that aha moment. And it's emotional for me when I see that in the email, because even though I don't have the time to go through them, when I start to read them, I get hooked and I have to read them to the end. And it's such a good feeling. And I just do a real quick bullet point response, because I want to say a whole lot more, but I have other things I got to get done. So I hope you don't look at my responses as not as celebratory as you may have expected, because believe me, I'm prancing around the house like a peacock. I love it. I love it. I'm telling you, I love it. It gets me going. It gets me all hopped up because I know exactly what it felt like for me. And all of you are going to have that moment. I don't know exactly where. I don't know what it's going to be that makes it happen for you, but it's such an awesome feeling when people tell me I see and understand my model. I know what I'm looking for, and I watched it for the last couple of weeks, or I watched it the other day, and the first time it unfolded perfectly like I was expecting. And that is such an emotional experience. Like, you can't tell me, even those of you that had sent me that email, you're smiling right now and you're like, I know. But be honest, doesn't it feel like your email doesn't even scratch the surface to how good it feels? Like, it's amazing. Like, you feel like you're going to get a knock at the door. Like, someone's coming. Does you know something you're not supposed to know? I mean, think about what we've been doing for the last couple of weeks. We're calling the market before it goes there and turning where we want it to. Who else does that? Nobody does that. They get once in a while right, and they make a big grand stand about it. Look at what we're doing. This has been going on for decades with me. Quietly, under the radar, drawing no attention to myself. Imagine me walking around knowing this stuff and looking at people on the internet bragging about what they can do with these indicators and moving averages and animal patterns and how silly that stuff is. And then you can look at this and it's just like, what? Yeah. And it makes you wonder how much money is being made by people that know how to do this, and they have billions of dollars backing them. You can't comprehend that kind of money. It's ridiculous. Like, it's ridiculous. And that's what the central bank does. It cannibalizes institutional trading. They provide liquidity, but they cannibalize on those traders as well. Because the Goldman Sachs boys, okay, the UBS, the Citi guys, they are not the upper echelon. They are not, okay? They're good. They're better than retail. I'm not trying to diminish that. They're good. But they don't know what you're learning. It's not taught in any of their curriculum, and none of the traders at their desks know this stuff. You're learning things that you're not supposed to know. You're not supposed to have this perspective, because this is the 90% bracket that's on the other end of the 90% bracket that loses. Remember, it's a net sum zero game. For every winner, there's a loser. So if there's a category that they constantly tell you, 90% of traders lose money. Okay, well, who took the other side of those trades? There's two sides of every coin. So, yes, I teach you how the losing crowd loses. That's what those free tutorials do. In here, I flip that coin over and I show you what the other half is doing. How am I calling the markets like this? It's not retail. There's no books. There's no courses. It's just this. And I don't know what you're able to do with this. Like, I don't know what you're going to be able to do and where your threshold is. Like, when is success for you? That's all personal. And that's the part that I can't wait to read. I want to hear your stories. Like, I want you to do some amazing things. Not teach my stuff, not rebrand it. But if you want to do signal services and just smash it, not teaching them what you're doing to make the signals, but give the signals. Some of you in here are so hopped up about trying to make money, and you're doing it wrong by trying to sell my content. If you just submit to this stuff, learn how to do it, you would have a huge crowd literally at your beck and call. Anytime you want to open up a signal service and say, hey, watch me for a month, I'm going to do it for free. Nobody's willing to do that. Nobody out there that does signal services go out there and do a signal service for a month for free and put themselves on the line, because they don't trade well. They don't. They get you in here and, okay, we have a really good way of managing money. We can absorb 50% losing and still make money. I don't like that. I don't know about you, but I don't like being wrong half the time. I hate that. To me, that just drives me nuts. And now you're going to ask me to risk my money on a 50-50? I could do 50-50. Flip a quarter. That's the same thing. You're going to find your niche in this, and you're going to be happy once you find it. And try not to overdo it. Don't tweak it. Don't supercharge it. Okay. Just find contentment in enough. And if you can just simply accept just a little measly 1% each time you enter the market, and that's what happens as a result, and then you get stopped out on the balance, you still are going to do phenomenal if you're consistent. Like if you ever sat down with a spreadsheet or calculator and just worked out the numbers, and you basically have 20 trading days a month. Now you're not going to be profitable every single day. That's not realistic. Besides, you have non-farm payroll in there, and you have other days where there'll be heavy-duty impacts to the economic calendar, so you want to be mindful of that. That's going to cause concern, or maybe a day off. So it's not I'm going to trade every day. There's times when you want to make sure that you're respecting that risk. Sure, you could make opportunities out of that day, but why? Why push it like that day? You don't need to. So if you frame it where you're making anywhere between 8 to 20% per month. Now, I'm not saying this is something that you should expect, but I'm saying as a target, that means that you've been doing it for a while, you're consistent, and you're able to manage your money correctly and not feel impulsive about, I have to take a trade. If you didn't take a trade in the last 2 days, are you dying to get into the market now? If you are, then you haven't controlled yourself yet, and you have to do more of abstaining from trading. And you condition yourself by doing that. And don't even look at the market. Don't even look at charts. Don't even paper trade it. That's how you fix that part. So once you get to that point where you can manage yourself well, and you're disciplined, and you understand what you're looking for in your model, and you can understand institutional order flow, it is very easy to make 8% a month. And it's realistic to make 20% per month. 20% is literally 5% a week. Like that's nothing. Like that is literally nothing. You in years ago where we were trying to look for a certificate of deposit in the bank, I have a friend of mine that's family's very rich, and he would always ask me, what do you think this CD would be? And it would be like paying like 4%. You got to keep the money tied up for like 3 years or whatever. I said, why are you doing that? Like, you're trying to put millions of dollars in certificate of deposit, where if you just put your money in a currency and hold it for 6 months, just trading unleveraged, if you put $1 million in there and you trade $1 million unleveraged, like you would smash it. That's ridiculous returns at that level of money. And he's running around asking me about certificate of deposit. Well, he's now trading, but not doing discretionary trading like us. He's doing index trading with a firm. So they put him in an index, and they just let the index rally, and they get all the credit for doing nothing. That, to me, is lazy. But if that's what is needed for him to finally get to the point where he falls in love with the profits of trading, that's cool. Because I'm trying to teach him to break away from that and do his own thing. If you find a way of making a signal service and you are not violating your agreement here, you will be touching the lives of so many people, and they will love you for it. And you don't have to teach what you've learned here. You don't have to teach that. Some of you are in such a hurry that you want to put my name out there as an enticement. Come on, I'll teach you everything ICT is doing to make money. And then that's going to be your scratch. That's going to be your bankroll that you start trading with. I'm telling you, don't be surprised if that fails for you and you blow it, because that's what's going to happen, because you're doing it wrong. You're trying to take something and do something with it it's not meant to do, and you will not. It's like having sand in your well. You're not going to get it like that. You might think you will, but it isn't going to work for you. If you are a signal provider with this content and you're not teaching it and you're just giving the signals, you will create such an enigma around you. It'll be like mysterious. Now, most people will be like really drawn into saying this person is lucky a lot, and they're going to come to watch you fail. And that's why you give them a month. And if you're consistently finding setups and you're delivering it with the results, their jaws are going to hit the floor, man. It's they're not going to see this anywhere else. And that's, if I had to start all over again, if I had to start completely all over again, no money, lost everything, what would ICT do? I would literally go on YouTube without any reference to me, and I would say, okay, I'm going to, and I would do it with text. You would not see me. It would just be comments that would come up on the screen. No talking. I wouldn't dress my charts up. It wouldn't have any annotations whatsoever. I would just put an arrow right where I'm going to try to get in at. And when it trades there, I put the trade on. And I would do that for a month. And then I'd say, at the end of this month, I'm going to make it available to you if you join this room. And I don't care if people copied me, because I know I would make a lot of money right away. And that would put me in a position where I'd have a huge bankroll. And then I would just do what I already know. And I'm done again. How much time? About a year. I wouldn't have what I have now, obviously. I'm not saying that. But I'm saying, as far as being comfortable for the rest of my life, it would take me a year. And I would be using other people's money. But don't take my content and prostitute it to try to get that bankroll to make money to go start trading, because you're going to fail doing that. I promise you're going to fail. I guarantee it. That's cursed. Oh, don't give me that. You're going to see. You're going to see. If you do it the right way, you'll have a clear conscience, and you'll have every advantage on your side. And you have no idea how many people out there ask me to do signal services. Like, it's unbelievable. So and I know some of you aren't even interested in this, and that's the reason why I put a disclaimer up saying, we're going to be talking about things that are not really technical. The level of interest in people wanting to make money but not learning, they're not interested in learning. It's too much. It's too hard. I don't want to do it. Like, there's a lot of people that lost their job. There's a ton of people that lost their job. And they're dying for any way to make money in these markets. If you learn this, okay, if you learn this, you would be such a blessing to some. I mean, look, even if I advertised, say I advertised and I wanted to do a signal service, which I have no interest in doing. I want to dial back my activity. I'm going to go back to being reclusive again. But some of you are hot shots and young, and you have all this energy right now. If you can bottle that and put that into a signal service, you have no idea how much money would be coming to you. You won't be able to manage it. Like, honestly, you will not be able to manage that many people coming in, because they're going to tell people what they're doing, and they're going to tell people, and that's real multi-level marketing. That's the real way of doing it. You don't have to convince people. They're going to see it. That's the difference. When you really have something that's real, you give it away for free. Do a whole month of it. Let them see everything. Be transparent about everything. And man, you will see people throwing money at you. Throwing it at you. Please take my money. I want to join right now. And as long as they're making money, they will not care that you are not teaching them. So who's going to be in demand all the time? You are. They're not going to understand what you're doing, which is going to drive them crazy. Okay? It's a mystery. It's a romance because they're in love with you. They just can't separate from you. You're probably going to have people like literally, trying to find everything about you, stalking you, because they want to know everything about that person that's calling these market moves. And if someone is very, very, very creative in their marketing, like, man, you could literally mint yourself in less than a year and never have put a significant amount of money in the marketplace or ever risk any more of your own money. Think about that. What's the rate of return if you give signals with a demo account and you make millions of dollars a year on subscriptions? What's the rate of return on that? It's infinite. It's infinite because you really are putting no money up on your own, but you are giving someone else access to a skill set that they don't have, and they have to continuously pay. Now, you can see how clearly I could have abused all of you if that was my nature or character, because I could keep you on this monthly dopamine, and most of you would keep paying. I don't do that. And signal services are meant for that. They knew what they were getting into when they sign up. So I don't think there's a conflict of interest there. It's a service. They want to be a part of it. They have to pay. But you are on the hook. That means you have to deliver. So the best way to manage that is not have your own money at risk and do everything from demo. And also that's how you beat the regulations, because you have to be very, very careful if you operate with a live account and tell people, I made this much money. I'm saying that if I made this much money, you can make this much money. Boom, you're in trouble. Okay. If you show them for a month, they're not going to care that it's a demo. They're not. And the ones that make a big deal about it, they never would have paid you anyway. You just look past them. But you have the opportunity to carve out such a lucrative career for yourself that you could use to bankroll your own trading. If you don't have a whole lot of money right now, that's one way you can do it real quick. And when you get feedback from folks that just simply show affection for you for what you do, and you have a clear conscience because you have not violated anything with me, can you imagine the balance and joy that you're going to have? If that's where you want to go, I'm not trying to talk anybody into doing signal service. I'm saying that there's a large crowd of you that want to do that. And I'm speaking to you. But you have no idea how amazing that would feel to live your life knowing that what you're doing is impacting other people positively. And you have residual income is for as long as you want it. That's exciting. And you don't need a job. You don't care about having it. You don't want one, because that kind of money, it changes your understanding about everything. And for some of you, it's going to cause you to become reckless and silly like I did when I was young. But you'll always have an income stream, period. If you ever hit rock bottom, you can start right back up again. Something happens, you have a divorce, God forbid, something like that happens. It just, you can reboot and respawn and do it all over again. And that's what I had to do. I had to do all of that. But some of you don't want to do signal services. Some of you want to be fund managers. That takes a lot of courage. It takes a lot of courage, and it's hard for me to sleep. Doing those types of things is stressful. It is not something that is for everyone. And there are certain individuals that have that, that hardwiring in their head that they can do it. I personally wasn't comfortable doing it. I'm okay with the risks that I can take, but no matter how well you do, it's never good enough. And if you don't do well, it's the worst. Like, they want your head on a block. So it's a thankless career if you're going to be a money manager. Okay, if you manage funds, it's very stressful. But the quick and easy, dirty way of doing it that makes a lot of money real fast is the signal service. That will absolutely put so much money in your hands that it'll be easy for you to say, I don't even need to trade. I'll just call the signals and I don't need to take any risk on. And to me, I think that's the smartest way of doing it, because then you're not emotionally attached. You're just really working off of the objectivity of looking at the price. But it's going to feel weird when you see all that money coming to you. And if you've never seen that kind of money coming in, it can be very intimidating and cause you to second guess yourself, which is the reason why you have to learn what you're doing here and stretch it out. That's why I said, man, a year and a half, that's about the minimum. And a lot of you aren't ready for that and don't want to do it. And I'm not going to do that. I'm going to go shorter. And you're going to fail. I'm just telling you, if you're going to do that, you're going to fail. And don't be surprised. And I don't even want to read the emails. I wish I would have listened. I don't want to read that. Okay. But I've appreciated all you guys sending me the emails that you've shared with me over the last couple of weeks. It's been encouraging. It's been remarkable for other reasons because of the stories that also have been shared with me. I haven't read all of them, so if I haven't gotten your email replied back, just know that it's hard for me to get to them. It's usually when I'm sitting with my phone and an email will pop across and gives me an alert, says so-and-so sent you an email. If it's a title that looks like it's intriguing, my obsessive compulsive disorder kicks in. I got to read it. And if it's not what I think it is, then I'll just save it as unread marked. But I've had a lot of fun this first month. And I know we have a couple more days left still, but I've had a lot of fun this month. And I hope that you've enjoyed this, but I also hope that you're preparing yourself for a whole lot of teaching now. You've seen a lot of this being used, and now I'm going to teach you a whole lot of theory and logic. And then once we get through that first wave of that, and then we'll go back to pointing where the market's going to go again, and then it'll be another wave of theory and logic, and then we'll do that throughout the year, okay? So that's kind of like the pace of what we're going to be doing. And I think that's going to be it for tonight. A little bit long-winded, but I enjoyed talking to you tonight. Hopefully you found this insightful. Until I talk to you tomorrow, be safe.